Hey everybody, welcome to Take the Win. This is our equity podcast, and in this podcast what we do is we interview different people throughout the organization, finding out about their experiences, primarily with money, personal finances and their careers and so on. So delighted actually to have in the studio today Gaurav Kashyap, one of the first people that I ever met at Equiti. Gaurav, how are you doing?
I'm doing very well, Jason, and I'm very pleased to be in your esteemed company as well.
My esteemed company.
Welcome back to Dubai.
Oh yeah, thank you very much. Yeah, it's been very, very pleasant this time. I wasn't so happy about coming back in December, but this is a lovely time of year to be here.
It's the best time to be back.
So good. I'm going to give a little personal anecdote. The first time that I met you, we were going into a very fancy schmancy place, weren't we? And you came to the door and you said, "Are you Jason?" I said, "Yes, I think I need a jacket to get in here." You said, "It's okay, brother, I've got you. Take my jacket." And then you were fancy enough to get in without the jacket. So I'm forever in your debt for that.
That was at the Arts Club, was it?
It was Arts Club.
That was. Yes, I don't know why they still have this rule of having a jacket.
I don't know.
But I'm very glad I could sort you out.
Thank you. Sorting the riffraff
yes,
from the, the normal people.
Absolutely.
Gaurav, the title for today's episode is Scared of Money. Yeah, some people have a fear of money. It's kind of a taboo subject for some people, not something that people feel confident to speak about. Let's open up with a broad one. Why do you think that is? Why do you think that people have that kind of fear around it?
I think it's absolutely crazy that this stigma around money exists.
Mm-hmm.
And most people you speak to, whether they're on the path to starting to invest or they have some kind of experience, there's always this stigma around money. And I think in essence, it stems from the fact that because they don't know about it, they're afraid to lose it. So that fear and that position of being risk averse is kind of what makes people scared to talk about it. I think early on in my career, my mentors always used to have this good philosophy that there is no stupid question.
Mm-hmm.
And I do think that there is no stupid question. I think the path to understanding and being comfortable with money is asking the right questions, surrounding yourself by the right people,
Mm-hmm.
to somehow reduce that stigma. Also, like we talk about it all the time, I was born and raised in Dubai. I went to the American school, and from the fourth grade, I memorized the entire list of 50 US presidents. I mean, what am I going to do by knowing who the 16th president was? You know what I mean?
Yeah.
So I think the education system also really needs to kind of pivot into teaching like really key life tools,
Mm-hmm.
investing and dealing with money, how to save, how to budget,
Mm-hmm.
home financing. I think these are all like really important things that are kind of neglected in the school system,
Yeah.
which by the time you're out of college, you're not armed with those tools. So then you become very scared to start studying these types of subjects or actually taking part in the financial markets.
100%. Couldn't agree more. I think there's little bits of the education system. It's kind of at the periphery, though, where we say, we build it into maths, citizenship, this kind of thing. You can do after-school clubs about trading and so on. But it's not the central thrust of the curriculum. And so,
Exactly.
Yeah, and I 100% agree. And it's kind of that, I think when things are unknown, that's generally when they become taboo as well. You mentioned there, you said about your role models or your mentors, right? When you think back to when you were young, I was reading something about from the National Endowment for Financial Education. A lot of what we learn about finance is through very, very early experiences with it and the people that were around. Who would you say are your financial kind of gurus or mentors or role models?
Well, I had a couple of professors in college at NYU.
Okay.
I mean, I ended up studying math and economics.
Okay.
So I'm one of those very few people that actually went into a career and made use of their diploma.
Yeah,
you know what I mean?
Yeah.
So I had a handful of professors, but even my home life, my dad was a petroleum engineer and he was super busy being successful. My mother was a homemaker, but even at the home, there was no financial literacy.
Mm-hmm.
My dad had a portfolio. He was, doing his own thing. And even from that time, there was no awareness towards investing. So look, I mean, just because I studied in this industry, you pick your key figures that guide your investment philosophy. Whether it's a Warren Buffett, it could be somebody you find on YouTube. But I think it's really important for people who are listening and who want to take that step into investing is to find somebody that they can relate to. Someone whose communication style is relatable, someone that they enjoy listening to. It could be this podcast, for example. But I think it's important to have a mentor like that can ultimately, spark that interest. Because look, Jason, it is quite nerve-wracking.
Mm-hmm.
Not only for the fact that, you work hard for your income, you have bills to pay. So you don't want to be in a position where you're like, I don't want to lose this.
Yeah.
I have bills to pay. So to remove these stigmas that we're talking about, it's important to find that kind of figure, however you choose to look at it.
That kind of relatability factor where it kind of guides and influences the way that you behave. You maybe pick up stock tips from them or something that you kind of think that, maybe even their exposure to risk and, how they kind of chart a course through financial markets.
Exactly.
My mother was very frugal. So you're just talking about your parents there. She was very frugal in terms of herself, but she always wanted to give us everything. We grew up in a reasonably kind of, I wouldn't say poor, but, it was a humble background. But she, during the Big Bang, I don't remember the Big Bang in the 1980s, financial markets in the UK opened up, share ownership, everybody could own shares, particularly in utilities.
It was a good time
this
in
kind
the
of
UK.
thing. And my mother bought those, and she still sends me dividend checks from some of these companies now.
Wow.
Still, it's crazy. But that was my first kind of experience of, money behaviors, all about frugality, but she was very, very risk averse. I still have that now. I find that I can't just invest in anything. I have to really, really know about it. And that really has enforced the type of kind of finance person that I am.
Or investor you are.
Yeah, exactly, yeah.
But see,
Yeah.
no, so the fact that, you said something which is very important, which is the fact that you identified from an early age that you were risk averse. You're a risk averse investor. Now, that doesn't mean you don't have deep pockets. That doesn't mean you don't have, it means you don't have the appetite, or maybe you don't want to have the appetite to take big chances in the market.
Yeah.
So right off the bat, you know what products would work for you and which products don't work for you.
Yeah.
So a lot of investors, they don't even are not even at that stage yet where they realize that, okay, look, maybe the volatility in crypto markets is definitely not good for you. Mm-hmm. Highly leveraged FX or commodities also may not be your cup of tea. So hey, maybe a balanced growth fund, which gives 7% a year, will make you sleep peacefully at night. You know what I mean?
And it will. I'm very happy with that.
Exactly. So, I mean, that's the beauty of our industry. Like, there's so many different products out there, and there's something for everybody. It all depends on kind of how you profile yourself, how you view yourself, and of course, what your ultimate goals are. Because there is an opportunity in our markets. It's just, it takes a bit of patience, and it takes, of course, education, which is kind of what we're trying to do with this excellent podcast that,
Absolutely. It's certainly part of the journey, isn't it? And I hope people take it for that as well. And, this fear of money, well, let's demystify it. It's a very trendy word, isn't it? But, just to make it so that it's a bit more approachable. Well, that's me. What about you? How would you describe yourself? So, 10,000 feet up, how would you describe Gaurav? What does he do? What are you like as an investor?
So I've tried my hand at everything. I would probably say, so my whole introspection on seeing what kind of targets and goals I've had, obviously I've gone through many phases of my life. I was a college student. I didn't have any kind of responsibilities. I didn't have a partner at that time. So obviously I could take more risks. So I have dabbled in cryptos. I have done my fair share of leverage FX trading, both of which, didn't go as well as I expected. But look, those are all learning experiences as well. How to be a successful trader versus how to be a good investor. I mean, there's always a difference between investing and trading. Trading is more short term, looking for quick wins, whereas investing is more of a slow burn. My investing journey, I probably started when I was in my mid-20s. I wish I did start earlier, straight out of college. But yeah, I learned about compounding interest at a very, very early age, and I'm glad I did. And again, this is through my education and through my own fact finding and discovery. But yeah, I've had my fair share of wins and losses. Look, you're not gonna find anyone who has a 10 on 10 or 100% strike rate, right?
If you do, they're lying.
Exactly. if they do, they are definitely lying. But I think what it comes down to is try to have a better ratio than 50-50, but make sure that your wins are always bigger than your losses. I know it's very easy to say, but these things come with time and experience, especially if you're trading. But if you're investing, obviously it's a lot more straightforward and a lot easier.
Let's delve into that though, and I think sometimes people have a fear of money. There's almost a kind of a moral aspect to it. So it's not just maybe you don't have deep pockets, as you were saying, and maybe you don't have so much money. It's kind of like that's a moral failing. I think that there's a lot behind that, and particularly where you've maybe lost some money. So you think you've made a calculated bet, you've done your proper risk assessment, and your account blows up, or you lose a lot of money. Have you ever had any situations like that? And have you ever had that kind of feeling where it's like, this is more than losing money?
The end of the world?
Yeah, this is kind of losing a part of myself.
The end of the world?
Yeah.
Yeah, that's like part and parcel of trading. And just for our listeners, this is purely a trading comment. It's not about investing, because investing is more of a slow burn, as we were talking about. But yeah, in trading all the time, you see on your trading platform that the market all of a sudden goes against you, and the losses keep building up more and more and more, and it's a really bad feeling. I think what kind of helps me when I'm in those situations is that either A, you take the loss, or you reach a point in your strategy where you know exactly how much you're ready to lose.
Yeah.
So, equity and most brokers, they always talk about risk management, take profits, put stop losses. So these are actually there to reduce that psychological degradation that most traders face.
Yeah.
And I mean, it's hard, Jason. It's a 24-hour market. It's open from Monday to Friday. You can't go to sleep with an open position and you have an M2M of, let's say, $25,000. You're 50 pips away from being stopped out and losing a substantial amount of money.
Yeah.
Tell me, how difficult is that psychologically? It's hard. It's very, very hard. So these tools that brokers do, shove down our throats, implement a nice stop loss, implement your take profits. These are actually tools that can enhance your trading experience.
Yeah. And just to come back to that then, because I think you've kind of, I'm taking it as this, I'm interpreting it in this way. You've said that at least you understand that you're risk averse. Now, for me, that's kind of like when we talk about trading plans or in our education library, a lot of what we've done on our socials, but also in our evergreen articles. It's
amazing work, by the way.
Thank you. Well, that's all the marketing team, the content articles, we've kind of worked through those and they're being optimized and so on. But yeah, a lot of that is marketing. But for instance, we talk about a trading plan, and it's about setting goals, understanding exactly why you're in the markets and, and what your game plan is and so on. What would be like your investment sort of plan? So not a trading plan, but an investment plan. Like for me, I'm kind of like identifying who you are, and then you kind of know, which kind of ground you're working with. But like, what would be your investment plan?
So I always tell like my loved ones, my younger cousins who are, graduating out of university or fresh out of high school, you can invest or you can trade. I mean, I do both. I invest. I have a portfolio, a joint portfolio between me and my wife, and I don't employ somebody to manage that portfolio. I do it myself because I'm in the business.
Sure.
I follow markets. So I think it's such an important thing, which ties back to what I was talking about earlier about the education system failing in not instructing youngsters to consider investing from a younger age. But I think it's quite simple. Once you do your budgets every month, you know how much you have to spend towards rent, you know how much you have to spend towards food and drink, your entertainment, your golf hobby. Everyone has expenses, right?
Yeah.
Once you find that winning number, what I think people don't realize is that you don't need to have big money to start investing. This is another stigma about the financial markets. People think that you have to have very, very deep pockets, or you have to start with millions or hundreds of thousands of dollars, which is absolutely not true. You can literally start investing in a very, very safe fund that gives you 7 to 9% annually, with as little as $1,000 a month.
Yeah, and the sooner you start that, the better.
The sooner you start, the better.
My singular failing in life, I would say.
Look, it's never too late, Jason. It's honestly, it's never too late.
Okay.
It's never too late. I think one of the fantastic things that Equiti is doing, along with Take the Win podcasts, a very, very exciting update that's going to come very soon to the markets, is that we're launching a Equiti Global Balanced Fund. So
Amazing.
In extension to our existing brokerage services, we are launching a highly regulated, ESCA regulated investment fund. And what this fund does is we have a fund manager, a very, very intelligent up-and-coming fund manager called Femina Hudani.
Yeah, she's excellent.
Who I've been working with quite closely. So she's very educated, a CFA. She'll be launching this fund hopefully towards the tail end of Q1 of 2025. And what we will be doing is we will be opening the door to new investors, investors such as yourself who are maybe risk averse, and we'll be unlocking investment opportunities for them. And this is something that is a very, very easy plug and play for a lot of people that don't have the time to track markets, who don't have the time to set up a brokerage account, who don't have the time to, pick what stocks they want to do. So it's a very easy way for them to take part in the financial markets and over time benefit from this compounding interest phenomena that I don't think people talk about enough.
Absolutely. And I think that's great for us to have that kind of service provision. It really opens us up to a lot more customers, right, and different types of people. One of the very first times, I don't know if you remember this actually, but I remember you and Mark Lee, one of our traders, our head of commercial projects and trading, you invited me into the trading room. I felt very special. And I said, listen, I've done a economics and management degree, but I have no idea what all of this stuff is. We never covered this at university. We never did these things. I said, so you're going to have to break it down. So there are just no assumed knowledge, everything, right? Let's ask that question then. So let's have like a kind of a professor moment. You break it down. You said a fund, an Equiti Global Balance Fund. What, you say that off the cuff like it's, yeah, everybody knows what that is. What does that mean? What is a fund?
So that's a great question, Jason. So one of the investment vehicles that are there in our financial markets are these funds. So a fund is basically, depends on the strategy of the fund, but there are hundreds of thousands of funds out there in all the countries. Yeah. And basically every fund has a mandate and a target and a goal. And depending on what the mandate is, the fund managers are basically deploy the capital that they collect into various sectors. It could be equities, it could be debt, it could be fixed income. So the fund manager decides the allocation and they collect the money from clients, and then they deploy that capital, that money from their clients, into these various asset classes. So it's the fund manager obviously has a track record. They have years and years of experience. You can even track the performance of these funds over the years. And you can actually literally go into the app and select which fund you want. I mean, if you care about the environment, for example, you could literally find a fund out there on the platform which is an eco-friendly fund, for example. Or you could find, if you have a view on emerging markets, for example, and you are bullish emerging markets, you could find a fund that is focused more on emerging markets. Now that fund manager would invest based on their mandate. They build a mandate themselves, they build a strategy themselves, and then they invest proportions into those particular markets, whether it be equity or it be debt or government debt, for example.
And that composition then is, I suppose that's the beauty of it, is that within your fund, you're looking at the underlying performance of all of those things.
Exactly.
Those different asset classes.
Exactly.
And so one maybe potentially could be doing not so well, and then the other was doing better, and so on.
Exactly.
But you're getting like a broad base of maybe returns within those sectors.
Exactly.
Those industries,
Exactly.
Right. Okay.
And everything is transparent. Everything is published, so you can actually see the track record over the years.
Right. Okay.
Obviously, nothing is guaranteed in this world, but that historic track record over the years, it gives you a really, really good idea about what the returns could be. I mean, I want to tell all my listeners very simply, Jason, you just take a chart of the S&P 500 over the last 20 years, and you'll see year on year, the S&P gives you 10% a year return. Okay, there have been a couple of years, particularly in 2008 when the financial crisis was there. The market was down, I think, more than 25% off the top of my head for that particular year. But if you look over the course of the last 20 years, if you put money into the S&P every single year, you're compounding at 10% every single year. So the concept is the same. The concept is very, very similar. The fund manager, he or she would probably deploy some percentage of the fund into the S&P. They may deploy the rest into something safer like US Treasuries to offset that risk. So it all depends on the structure of the fund.
Okay. Yeah, it's good. And it's like, I think that we talked about this before, but I think that with this fear of money, with that kind of, it's almost like a phobia, isn't it? And people don't want to ask questions which kind of sound stupid. I actually really don't mind that. And I think over the last 3 years, there's enough people that have met me where I've been asking stupid questions about all sorts. Whether it's our funnel, marketing, how the technology works, our tech stack. There's so many different things that I've asked stupid questions about. But actually, as a result of that, I've learned quite a bit.
So much more,
I feel
right?
like kind of comfortable with it now. Obviously, I don't know how to actually use these technologies myself, but at least you kind of have that, a general view of how things work. And it's nice to be in that position. So, like, what kind of questions? Because this is kind of, as an ex-educator, sometimes what we were trying to empower children to do was to ask the right questions. Almost like a taxonomy of questions, searching questions, closed questions, questions that open up the debate, questions which center on the very topic at hand based upon the keywords, et cetera, et cetera. What kind of questions do you think that people should ask, and they should ask maybe a bit more confidently and maybe not feel so bad about it?
I think the first thing is they should ask about the risks. Inherently, everything in life has risk, and financial markets are no exception. There is a risk to investing, and I think a lot of the experiences of the people who have had a bad experience in the financial markets is because they don't understand the risks. They're not aware of the risks. They've not profiled themselves like you have. They don't understand. They don't understand what the products are. So I think the main thing is to understand your risk profile first and foremost.
Okay.
And understand the products also. You know.
Yeah.
There are so many financial products out there. It can be extremely overwhelming for any kind of investor. But I think that's the job of the broker also. I think the broker should be an open line of communication with the clients, and the client should lean on their brokers, to give them this kind of information. You know what I mean?
Yeah, absolutely. Yeah.
I mean, the broker's job is not only execution or opening the account. It should be also helping the client on his journey, like even the after sales support.
Yeah.
It's quite important.
We're going into, well, we've probably been saying this for the last 10 years, but they're kind of totemic times. There's a lot of disruption. There's all sorts changing. We've just had a new model of an LLM that's been introduced by China or a Chinese company.
I know, what a crazy week it's been.
Yeah, you think about the impact that's had on tech stocks and over tech assets. In the context of that kind of milieu, that mix of things that are going on, what do you think it is that people need to think about in terms of their investment strategy, given the geopolitical landscape, etc.?
That's a great question, Jason, and I can answer it in two different ways. If you're a long-term investor, such as myself, every month I take out a portion of my salary, and I plug it into the markets, into a mix of stocks and indices that I actually track.
And you're managing that yourself rather than just putting it into, for instance, like you said, a fund or an ETF or something like that?
Yeah, so for the time being, because of my job, I invest it myself. But towards the end of this quarter, I'm going to start investing in Equities Global Balance Fund.
Yeah.
And I'm going to be chasing you down in the UK to also get you onboarded. But yeah, it's just taking a percentage out and plugging it into that fund. And look, Jason, for long term, for people who have a 10 or 15 or 20 year investment horizon, honestly, I don't think it's going to make a difference, because most of these funds are investing in asset classes that are going to be there in the next 10, 15 years.
Yeah.
We aren't talking about meme coins. We're not talking about cryptos.
Sure.
We're talking about companies that are going to be there for our kids' generation and our grandkids' generation. So from a longer term perspective, I would not pay too much attention to the daily noise, whether it be DeepSeek or who's sitting in the White House at the moment. These things are all transitional, and ultimately it all evens out. As I told you, like over the last 20 years, the S&P is averaging 10%. And what all have we seen in the last 20 years? We've had COVID, we've had many different presidents, we've had so many different wars. So long term, it doesn't really make a difference. But for those short term traders, maybe on our brokerage side of the business, there can be a lot of volatility coming up, potentially a lot of volatility, especially with these upcoming tariffs, future Fed policy. There is going to be a lot of volatility. But again, long term, I think it's just noise. I think if you just stick to your guns and you stay consistent and you follow your plan, I think every investor will be okay.
This is it, right? I used to have an economics professor, and he'd say, "Hey, look, it goes down. Let me zero in on this, and it's going down here, isn't it? Oh, that looks terrible.
Yeah.
Well, let's just zoom out, and what's it doing? It's doing this, right?
Exactly.
And I think that, I think that's the point you're making, and I think it's key, isn't it? It's just generally it's going up, and I don't think that we're entering kind of end times where it's going to plateau or something.
No, absolutely not. Absolutely not. And that's the thing. Like, I'm glad this podcast is called Take the Win. It's not called Quick Wins.
Yeah.
I don't know what it is, whether it's social media or maybe I'm just getting old, but I think like we are littered. This generation is littered with instant gratification. I don't think the recent crypto boom is helping because people are making quick money very, very fast. But as fast as you can make money, that's as fast as you can lose money.
Yeah.
So I think the key message that I think the upcoming Equity Wealth team is going to push is that it's a slow burn, but you are going to preserve your capital. And at the end of the day, because of all these wonderful things such as compounding interest, you are going to be very, very validified in 10, 15, 20 years, depending on what your investment horizon is.
Okay. I just want to ask two more questions, actually, and they're kind of related, one on a personal level, and then one to one of the original points you made about education. So, you know, I've got 3 daughters and 1 son. Maybe their dad isn't as smart as an NYU economics and maths grad. If they were sat here in front of you now, and they said, "Hey, Gaurav, our grandfather's just given us $1,000, or our grandmother's just given us $1,000. What should we do with it?" What do you? That would be a very intelligent question for them to ask. To be fair, maybe the 10-year-old would be capable of it. But what would you say to them in a child-friendly manner that allows them to think, "Okay, I can carry that information with me"?
I would, without getting into too much nitty-gritty.
Exactly. Yeah.
I would try to understand what their interests were, what their passions were, if they were at an age where they follow a particular industry, or if they had any aspirations. But I would definitely push them towards a product like the Equity Global Balance Fund, or as simple as getting Dad Jason Clarke to open up a brokerage account and quite literally, quite simply buying them an S&P index.
Yeah. Okay. Very good.
Quite simply, it's honestly as simple as that.
Let me just write
It's
that down.
as simple as that.
Let's broaden that out then, and beyond my own selfish interest for my children. You talked about schools. Imagine that you were, I don't know, part of a working party that was set to design a revolutionary new way of having a curriculum in schools for finance. If there were just 3 topics that had to be covered over the course of a year, what do you think those 3 things would be? That's a tough question, I think. But yeah, what would be the 3 things there's overarching topics for every kid to have a basic understanding of how markets work and how they can benefit from it?
I think the first topic would be how to budget, how to save.
Yeah, nice.
I saw a crazy story, not story, but a way of explaining how to save. All right. So hear me out on this.
Okay.
There are 2 people, okay?
Yeah.
One person loves drinking their coffee. We all love coffee. Are you a coffee drinker or a tea drinker?
Strictly for medicinal purposes, yeah.
Okay.
I have to, yeah.
Fair enough. So this is a crazy example of what financial knowledge can do for you. So let's say there's a person, he or she loves their Starbucks.
Yeah.
A typical latte or cappuccino costs about $6 US dollars for a cappuccino. Let's assume the person buys a cappuccino. You drink a coffee every single day.
Okay.
So 30 days in a month, we have about, let's say, $200 is spent a month on Starbucks. You have 12 months in a year, so you're talking about close to $2,200 a year. In 20 years, you're spending about $40,000 at Starbucks.
Wow.
Which it sounds like a lot, right? It is a lot.
You just go to the Equity Cafe instead.
Yeah, exactly. Go to the Equity Cafe instead. So you can buy that coffee at Starbucks for $6 a cup for every single day of the year and end up paying $40,000. Whereas a person B takes that $6 instead of buying the coffee for $6 and not drinking it for free in the Equity Cafe. That $2,000 that he would have spent per month would have generated him $164,000
over that same time frame,
over a 20-year period. So he would have contributed the same amount, $40,000 a year.
Yeah.
And after 20 years, because of the beauty of compounding interest, dividends, stock appreciation, that same person would have taken home $165,000 on top.
Wow.
That just puts it into perspective, right?
It really does, and it's a very powerful kind of explanation of compound interest rates and also frugality and saving money. And it also really makes me afraid, and I'm thinking like, oh God, I really need to get going. I need to go back 5 years.
Yeah, exactly. So schools should teach this.
Yeah.
I mean, it is the eighth wonder of the world for a reason. And I don't think a lot of people, are aware of the power of compounding interest. I think it's such an important tool that every financial institution should really ram down the throat of all their students.
Okay. Well, let's go with compound interest and saving then.
Let's do it.
That's our manifesto for the new schools.
Let's do it.
Awesome. Honestly, thank you. It's always a pleasure speaking to you, Gaurav. Thank you, listeners, as well. Hopefully you've learned something. If not, at least it's maybe given you an attitudinal shift about speaking and talking and learning about money. Thank you for joining us. Take care. Take the win.